Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets buried deep within corporate filings. Today, we're diving into a filing that involves a significant financial maneuver, and let's just say it involves some hefty sums and strategic moves that could reshape the company's future. You won't want to miss this, and hey, if you dig these kinds of behind-the-scenes corporate breakdowns, make sure you're subscribed. Also, we've got a fantastic community over on Discord, so hop in if you want to discuss these filings further. The link is in the description below. Alright, let's get straight into it. We're looking at a Form 8K filing from American Axle and Manufacturing Holdings, incorporated ticker symbol AXLE now. An 8K is basically a report that companies file to announce major events that shareholders should know about. Think of it as the company's urgent bulletin board. The big news here, kicking off on the 3rd of October 2025, is about locking down some serious funding. The company, through a wholly owned subsidiary, issued two types of notes, basically long-term loans from investors. They've pulled in $850 million in what they're calling senior secured notes, maturing in 2032 with an interest rate of 6.375%. What does senior secured mean? It means these lenders get paid back first if things go south, and their loan is backed by a strong chunk of the company's assets. It's like having collateral on your loan. On top of that, they've issued another $1.25 billion in senior unsecured notes, maturing in 2033 at a higher interest rate of 7.750%. Unsecured means there isn't specific collateral tied to this loan. Lenders on these unsecured notes are further down the line in terms of getting their money back if the company runs into trouble. It's a classic case of higher risk for the lender, hence the higher interest rate for the company. In total, that's a whopping $2.1 billion in debt raised on this single day. These deals are formalized through what are called indentures. Think of indentures as the rule books for these loans. The secured notes have their own indenture, and the unsecured notes have another. These documents lay out all the nitty-gritty details, how the interest is paid, what happens if the company misses payments, and importantly, the restrictions placed on the company. And these restrictions are pretty significant. The secured notes indenture, for example, puts limits on the company's ability to take on more debt, make certain types of payments, take out new loans secured by liens, sell off pieces of the business, or even merge with another company. It's essentially saying to the lenders, we will be careful with how we manage the company and its assets to make sure we can pay you back. The interest payments are set to start in April of 2026 and will happen twice a year, every the 15th of April and the 15th of October. The secured notes are due to be paid back in full by October 2032 and the unsecured notes by October 2033. They also have clauses allowing the company to redeem these notes early, meaning pay them back before the due date, but there are penalties or specific conditions attached, especially before October 2028. So, why all this borrowing? The filing spells it out. The main goal here is to fund a pending business combination, or in simpler terms, a merger or acquisition, with a company called Dowlais Group plc. This $2.1 billion is a massive chunk of change needed to make this deal happen. A significant portion of the funds will also go towards paying off all the existing debts of Dowlais and covering all the related costs, fees, and any extra charges. Once that's done, Dowlais' old loans will be wiped out. They also plan to use some of this money to make a change of control offer for some of Dowlais' other existing notes. This means if the merger happens, the holders of those specific Dowlais notes will have the option to sell them back to the combined company. And to res more, American Axle is also using some of these new funds to pay off some of its own older debts. They'll be redeeming all of their 6.50% notes due 2027, which had a balance of $500 million outstanding. They're also partially redeeming their 6.875% senior notes due 2028, taking care of $150 million out of a $400 million balance. This is about cleaning up their debt structure and likely getting better terms with the new, larger debt load. Now here is an interesting bit. A portion of the money raised from these new notes isn't going directly into the company's checking account just yet. It's being placed into special escrow accounts. These are like locked safety deposit boxes. For the secured notes, the entire amount raised, plus some extra to cover upfront interest, is held aside. This acts as an extra layer of security for those lenders. These funds in escrow are meant to be released once certain conditions related to the Dowlais merger are met by a specific date, which is currently set as the 29th of June 2026. If those conditions aren't met by then, Therese, a big what if. If the deal with Dowlais falls through or isn't completed by that deadline, the company is obligated to use the money in the escrow account to pay back the lenders of both the secured notes and $600 million of the unsecured notes. They have to return the original investment plus any accumulated interest. This is a pretty strong protection for investors, essentially a safety net if the acquisition doesn't go through. Following all this new borrowing and the preparations for the merger, the company has also officially terminated some previous agreements. They had some bridge credit agreements in place, which are essentially short-term loans designed to bridge the gap until longer-term financing, like these new notes, is secured. Since they've now secured the $2.1 billion from these new notes, those short-term bridge loans, which totaled over $1.3 billion, are no longer needed. So, on the 3rd of October, the same day they issued the new notes, they sent out termination notices, officially ending those temporary loan agreements. This tidies up their financing structure, moving from expensive short-term debt to long-term, lower cost debt. This next part is a bit of legalese, but it's important. Item 2.03 basically confirms that the creation of these new notes is a direct financial obligation for the company. It means the company is directly on the hook for these massive loans. It is not an off-balance sheet item hidden away. It's a big, bold financial commitment right on their books. Finally, the filing lists out the exhibits. These are the actual legal documents that back up everything we've just discussed. We're talking about the full indentures for both the secured and unsecured notes, and the forms of the actual notes themselves. These are the highly detailed legal contracts that govern these massive financial transactions. Now, let's talk about what this all means. American Axle and Manufacturing is making a huge bet on this combination with Dowlais Group plc. They are taking on a staggering amount of debt, over $2 billion, to finance this move. This is not pocket change. This kind of debt financing signals a strategic shift, aiming for significant growth, likely through economies of scale, market expansion, or a stronger product portfolio resulting from the merger. The fact that they are using a substantial portion of these funds to pay off existing debts, both their own and Dowlais, shows a clear strategy of deleveraging and streamlining their financial structure. This could lead to a healthier balance sheet in the long run, assuming the merger is successful and the combined entity can generate enough cash flow to service this new debt burden. However, this much debt is also a significant risk. If the Dowlais merger doesn't go as planned, or if the combined company struggles to perform in the market, they could find themselves in a very difficult financial situation. Interest payments alone will be substantial, and any economic downturn or operational hiccup could put them under immense pressure. The escrow arrangements provide some comfort for the lenders, especially on the unsecured notes, ensuring a fallback if the merger fails. But for the shareholders of Accel, this is a period of uncertainty. The success of this merger is absolutely critical to justifying this debt. Investors will be watching very closely to see how this acquisition unfolds and how well the integrated operations perform. In my opinion, this filing shows a company that is aggressively pursuing growth through acquisition, a strategy that can be very rewarding but also carries high stakes. They have secured substantial funding. A critical first step, the real test, will be in the successful integration of Dowlais and the sustained financial performance of the combined entity. Alright, that is our breakdown of American Axle's latest filing. What is your take on these massive debt issuances and this potential merger? Do you think it's a smart move for growth or a risky gamble? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribing ensures you don't miss our future deep dives. And don't forget to check out our Discord community, linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.